afternoon, everybody. Welcome to the August 19th, 2022 edition of News from the Front Lines of Business by DW Huff Consulting, where we help you know your numbers so that you can grow your numbers. So another hectic week here. The tax deadline is sneaking up on us here. So just in case you have forgotten, September 15th is the extended due date for corporations, and that is kind of sneaking up on us a little bit here. So anyway, not too much going on this week, but I'll share some conversations we had with some clients that were interesting, as well as a little update on the Inflation Recovery Act that's out there. But first point that really kind of jumped out at me this week has been something to kind of keep in mind. So we do a lot of entrepreneurs and people who are kind of hustlers and go-getters and trying to make money with rental properties and investments and that sort of thing. Serial entrepreneurs a lot of times. So we know that personality, they typically are going to find ways to generate money and make money. But this football analogy kind of came to light in a seminar, as well as the discussion that we had. And it's that football analogy. You probably heard, defense wins championships, right? So you can do all you want on offense, but the defense really is what wins them. And we've seen that over and over again with different Super Bowl appearances and that. And I think a lot of business owners kind of need to keep that in mind. And what we mean by defense is setting up your entities, your LLCs, and your corporations in such a way that protects you in the event something goes wrong and you have a lawsuit or some other kind of settlement coming against you, because creditors and tax issues can cause failure even more so than weak earnings. So there's a lot of ways when you set these things up at the beginning that can help avoid that. So we talk a lot about the LLCs, and at a minimum, every company you have should be protected in some sort of LLC. Separate checking account, and do all things. Follow all the formalities to keep things separate, so we don't have any kind of problems with somebody coming in and piercing the corporate veil and subjecting putting other assets at risk. So play by the rules there, and a little setup on the front end will save you some headaches down the line. So get with us on that. But we have some thoughts there and different types of holding companies that help you out in that respect, and definitely like to keep things anonymous where we can and avoid things that get in the public record, and just segregate everything to the extent that we can. So another topic. So this is from Jason Hartman. So he posts about 3 times a week. So I think this might be one of his slides here. So definitely give credit where it's due. His website there, jasonhartman.com. A lot of great advice on real estate. He interviews people on a regular basis that are very relevant to our type of people who affiliate with us. Businesses and I guess more so towards the real estate investors. But as we're looking at the investment landscape for this past year, we have a chart here that shows how things kind of went. S&P 500 being down, so we have a little breakdown here. Bitcoin and Ethereum are the biggest losers, right? So they're down over 50% in most cases, and depending on a day-to-day basis, those things are still pretty volatile and swinging in wide directions. But S&P 500, that's our basic stock market index. It's down 12% for the year. So and gold is also down 9%. So that's kind of unusual, in my opinion. Bitcoin, gold, those kind of things that are supposed to be stores of value, that are supposed to be tangible, more or less assets, are all down. At the same time, the stock market's down. So I would expect, in a time of high inflation like we are, and low stock market returns, that some of the other fixed assets would maintain more of the value, and that's not the case. But the one thing that is going up is real estate. So 23% here we see in our real estate market. So and that is kind of expected. In a high inflation market, you expect rents to increase. You expect property values to increase. So that is very much expected. When we're looking at a 10% inflation, more or less, to see 23% increase in real estate over the years is very expected, not surprising at all. However, some of the other stuff is, and that's what it is. So so I encourage you to, when we're thinking about where to invest, we don't want to just limit ourselves to stock market investments. We can do, even inside an IRA account, we can do these self-directed IRAs, or we can directly invest in real estate. So I would encourage everybody who has the means to do something to look at the big picture, look at everything, because these asset classes definitely don't live in a vacuum. Okay, so update on the Inflation Recovery Act. So we joke about that because the name is I think there's been some talk lately about, because when these bills get named, it's just a bunch of nonsense a lot of times, and the title a lot of times has very little to do with the provisions inside the bill, and that's definitely the case here. So much so that some Republican politicians are trying to pass some kind of rule. I didn't see exactly how they're going to enact this, but basically it's like, if you title the act Inflation Recovery Act, it needs to be inflation recovery provision. So they're going to make this kind of truth in advertising type rule here, and that would be helpful, sure. But on the tax credit side of things, so there are some things in it that are kind of interesting. So there is an extension of the credit out there for electric vehicles, $7,500 at the higher end of the range. All kind of limitations though. Certain manufacturers have already capped out, and there, some cars are not eligible at all. Some new ones are. There is a provision in there also for used electric vehicles where you can get 40%. So hopefully that'll help somebody. But this bigger thing I saw that's interesting, and really not, it's very different from anything else that's out there right now. We have some possibilities for some rebates for energy efficiency improvements to your home. So I don't know exactly the details of how they're going to break this out, but there's two different flavors here, and you can max this thing out at, it looks like $8,000, but depending on how the combination of things you add to your house with, and it could be insulation, more efficient appliances, roof improvements. Solar panels are a whole different credit, but all these things, what they're talking about is the efficiency that you gain by different additions. So it's a wide range of things you have to do, which seems like it would cost a heck of a lot of money. But if you achieve this this 20% level, you get $2,000. 35%, you can get up to another $4,000. And I forget what the bracket is for the next one. There's another improvement level that'll cap you out at $8,000 total received of these rebates, and it's a whole other separate program. It looks like it's going to be administered outside of the tax regime, so it looks like there'll be some other application with one of the federal agencies that's going to be kind of doling out the money as you qualify. So it's in the act, but it's not necessarily a tax act per se. But interesting, because it is a provision in this IRA act here that could help somebody, but it's expensive. I am kind of leery about these things, because in the past what we've seen is that some of those credits, like solar panels being the most obvious example, those things would cost $35,000 to have installed, but you had these $30,000 credits. So in theory, when the people come out and try to sell you on this idea, they would say, well, you pay $30,000, the credits reimburse you completely for your cost, and the electric savings is just free money after that. And what I've seen is that the electric savings has been negligible, not great, but something. So in theory, they're okay. However, now that we're a few years into this, and we're finding that certain components are now breaking. All right, so the way that the electricity gets stored and then transmitted to the house, and as a whole thing, there's these mechanical systems involved. And they wear out over time, and that's what's happening here. So now you get these what's turning out to be very expensive repairs to these solar panels. And when you factor in the repairs, and you've already wiped out everything with these tax credits, you're kind of going backwards now as far as the savings. So yeah, it's got to be, I guess hopefully we'll see some improvements in the durability and the efficiency of those things, because as it is now, and we just cut these credits, just kind of forcing people into this thing, and it's just not that great. So electric vehicles, all this stuff is just such in its infancy as far as the development as it is now. Most of these things just seem like it's just way more trouble than they're worth. So take that for what it's worth, and that's what the credits are. But we'll go into that in more detail as we kind of have time to to sift through some of the finer points and come up with some planning opportunities, because there may be a couple things that we can still use. So that's it. So our closing thought for the week here: worry about your character, not your reputation, because your character is who you are, and your reputation is what other people think of you. So once again, kind of the Stoic philosophy here comes to light. It's kind of control the things you can kind of control, which is what you do and how you think of things. So control those, and let the cards fall where they may with the rest of the stuff. So that's it for this week. We hope to get caught up on a few things at the office, and we'll see you next week.